After rising for a record 11 consecutive months and reaching an all-time high, the S&P ASX 200 index finally ended its upward trajectory in September, falling 2.7% for the month. The change in sentiment was driven by any number of concerns, including earnings growth peaking, central bank tapering of stimulus, rising bond yields, inflation fears, the US approaching its debt ceiling, and the state of the Chinese economy. The market's strong run has come despite Australia's two biggest economies, New South Wales and Victoria, being in lockdown for many months, from which they are now just emerging. While Australia may have initially lagged in its vaccination program, we can now boast one of the highest vaccination rates in the world. And with first dose numbers still rising, we may well end up being the most vaccinated country in the world. So while companies across many sectors like healthcare, retail, travel and tourism are operating at only partial capacity, we believe that many of the businesses most impacted by COVID lockdowns largely remain outside of the listed environment, in the small and mid-sized private space. At this time of the year following the AGM, we usually travel around the country meeting with our shareholders. We enjoy this interaction and the opportunity to answer questions on many aspects of our portfolio and the market in general. Unfortunately, this year in the current environment, it was not possible. In lieu of this face-to-face interaction, we recently released a video which covered many of the questions we are currently being asked by shareholders, as well as some of our current thoughts on the market. The video provides a more succinct format, separate to the formalities of today's AGM, to discuss these topics. For those shareholders who receive electronic communication, an email was sent with a link to the video, and it's also available on our website for anyone else who is interested. One topic that is worth further mention is the most recent corporate reporting season, which demonstrated strong earnings growth and a robust recovery for most industries. It also highlighted the benefits of strong fiscal stimulus, record low interest rates, a booming housing market, and strong commodity prices. The standout features were strong balance sheets and record dividends. In aggregate, Australian companies delivered a record $38 billion in dividends to shareholders during the reporting season, led by the iron ore miners, BHP, Rio Tinto and Fortescue Metals Group. These three companies alone paid $17 billion in dividends to shareholders. The strength of company earnings and the excellent condition of balance sheets was further demonstrated by the increased number of special dividends and a record number of buybacks announced, totaling in excess of $15 billion. We received a number of special dividends: Eagers Automotive, Milton Corporation, Rio Tinto, South32, Suncorp Group and Telstra. Currently, there are more companies in our portfolio undertaking buybacks than ever before, with many more spread across the market. Commonwealth Bank of Australia and Woolworths Group have just completed large off-market buybacks, while the other companies have elected on-market buybacks. We expect the continued health of company balance sheets, coupled with the low cost of debt, should support more company buybacks over the next 12 months. An extraordinary amount of capital has been allocated to equity markets globally, pushing valuations to record levels. This, combined with optimism of vaccination success, huge amounts of cash looking for returns, and increased levels of confidence, has seen a sharp bounce back in merger and acquisition activity and initial public offerings, two telltale signs of a buoyant equity market. Currently in our portfolio, we have ongoing takeover bids for Sydney Airport, Oil Search and Spark Infrastructure Group, with the takeover of Milton Corporation recently completed. However, it should be remembered that a significant number of takeover bids failed to proceed, with the failed bid for Iris one recent example. The number of new IPOs has reached a feverish high. Many of these are relatively small companies or businesses in the resources sector taking advantage of high commodity prices and the demand for newer commodities. However, there are many others we are assessing as potential new investments. Examples of just some of these, either just taken place or current IPOs, include Judo Bank, APM Human Services, EBR Systems, RAM Essential Services, SG Lottery, and Clarity Pharmaceuticals, but that's just to name a few. So this is a busy time for myself and the investment team, as the process of analysing and assessing new opportunities requires numerous meetings and due diligence. And that's not to mention the process involved to ensure we receive a meaningful allocation from the syndicate bankers. No presentation is currently complete without discussing environmental, social and governance matters, particularly the increased focus on the environment and decarbonisation. Companies are currently spending considerable time engaging with shareholders and other stakeholders regarding their ESG credentials and future strategy. Consideration of ESG factors has always formed an inherent part of our investment process, as they can have a significant impact on a company's long-term value and its return to shareholders. The investment team and myself spends a substantial amount of time researching and analysing these issues, including attending ESG investor days, not to mention the numerous ESG-related AGM resolutions of the companies in our portfolio. We believe it is our responsibility as a shareholder to engage with management of all companies in our portfolio regarding a range of ESG issues, not just environmental. Over the last financial year, we have held hundreds of meetings with company executives and over 50 meetings with company board members regarding these issues. Potential liabilities and future growth implications arising from ESG issues are factored into company forecasts and valuations when possible. Environmental factors we consider include carbon and greenhouse gas emissions and the use of renewable energy. In the lead up to the UN Climate Conference in Glasgow, the decarbonisation thematic continues to gather pace and commitments to net zero emission targets increase. With China, the US and India responsible for over half of current global emissions, to achieve these targets, the world will clearly need to be united. In addition, with government commitment, we believe large corporates who are well funded, have strong business models and sound balance sheets will also be a necessary part of the solution. To find out more, see Argo's Environmental, Social and Governance Investment Statement, which is available on our website. But despite the ongoing COVID pandemic, the global economy appears strong, with massive fiscal and monetary stimulus still in effect. Domestically, there is reason for optimism, with high vaccination rates and significant financial assistance from both federal and state governments. As the economy reopens, we hope to return to a more normal lifestyle as we're seeing overseas. However, confidence may be tested as stimulus is withdrawn and economic settings respond to the possibility of extended inflation and a return to more normal interest rate settings. So there are still plenty of risks confronting the Australian and global economies. COVID-19 is still with us. Market valuations are high, supply chain and logistics challenges are widespread, and geopolitical risks seem to be increasing. China's economic health, as always, will have an impact on global growth and Australia's commodity demand. With the market at these elevated levels, we do expect some volatility. However, with our diversified portfolio, no debt and cash available, we believe Argo is well positioned in the current environment. I'd also like to acknowledge the efforts of the whole team this year, who again under extraordinary circumstances in both our Adelaide and particularly Sydney office have done a great job to keep Argo fully functional. So thanks everyone. Also acknowledge the contribution from the chairman and non-executive directors, and I look forward to hopefully seeing them face to face in December, which will be the first time in over 6 months. So I wish all our shareholders well for the coming months. We thank you for your continued support and the trust that you have placed in us, and I hope we can meet with you in person sometime in 2022.